Samsung Electronics has just posted the strongest quarterly results in its history. In almost the same moment, the release of a Chinese AI model called Kimi K3 was linked to a sharp sell-off in US semiconductor stocks. Set those two developments side by side, and the deeper story becomes clear. Asia's AI infrastructure boom is producing very real profits, but it is also exposing how sensitive those profits may be to changes in technology assumptions, market psychology, supply chain resilience, capital allocation, and even global governance. This is not one clean narrative. It is 6 signals moving at once, and together they show where the AI build-out still looks powerful, and where it already looks more fragile than many investors may have assumed. The clearest evidence of strength comes from Samsung. The company reported record consolidated revenue of 171.5 trillion Korean won, an operating profit of 89.5 trillion won for the second quarter of 2026. Management pointed to demand for advanced memory, especially high-bandwidth memory, as well as high-performance computing components tied to AI infrastructure build-outs. That matters because it moves the AI story out of speculation and into financial statements. High-bandwidth memory is essential because AI accelerators need to move enormous volumes of data fast enough to keep up with training and inference workloads. When demand for that memory surges, it is one of the most direct signs that AI infrastructure spending is not just a narrative, but a monetized reality. It also reinforces South Korea's position in the physical foundations of the AI era, with Samsung and SK Hynix at the center of global advanced memory supply. Still, it is important not to overread a single quarter. A record result confirms present strength, not permanent immunity. Memory has long been a cyclical business, and one exceptional period does not erase the possibility of correction. It raises the standard. It does not remove the risk. That risk surfaced quickly, and in a form that says as much about investor psychology as about technology itself. Moonshot AI released Kimi K3, and the market response was immediate. A sharp sell-off across US semiconductor stocks. The important point is not that the model has already proved a lasting technical or commercial breakthrough. The available signal is the reaction. Investors appeared to fear that cheaper, more efficient, open-weight Chinese models could weaken one of the core assumptions behind the AI infrastructure trade. That competitive AI capability depends on ever larger and ever more expensive compute clusters. If comparable performance can be achieved with less hardware, then the case for limitless spending on chips and data centers becomes harder to defend at the margin. What makes this notable is the speed. Chinese model releases can now move American chip valuations before the real-world economics are fully verified. That suggests the competitive landscape is widened. Raw compute scale still matters, but efficiency is now a parallel axis of competition, and markets are trying to price that in before the evidence is complete. That kind of volatility does not stay confined to equity markets. In South Korea, it can quickly become a policy issue. After a semiconductor-led stock decline, Deputy Prime Minister Koo Yoon-cheol convened an emergency market review. Officials pointed to intensifying competition from China and to funding concerns around US technology firms as sources of pressure, while also saying Korea's underlying fundamentals remain solid. No specific policy package appears to have emerged from that meeting, at least in the available reporting, but the fact of the meeting is revealing on its own. Korean semiconductor valuations now sit where several pressures meet at once. Industrial competition from China, financing conditions surrounding US technology firms, and the confidence of Korea's own domestic market. When a government responds to a chip-driven market decline with an emergency review, it shows how central semiconductors have become to economic stability and how quickly global sentiment can translate into domestic political attention. Financial sensitivity is only one side of the risk picture. The other is physical disruption. An earthquake hit the Kumamoto region in Kyushu, Japan, and multiple semiconductor factories in the area halted operations. Renesas Electronics confirmed damage at its Kawajiri and Nishiki plants, including ceiling collapses, cracked walls, and water leaks. Kyushu has become one of Japan's most important semiconductor manufacturing clusters, especially for specialized fabrication capacity, including chips used in automotive applications. That concentration brings efficiency, but it also creates exposure. When production is clustered in one geography, a single natural disaster can threaten continuity across a wider manufacturing network at once. It is important to stay precise. The available reporting confirms disruption at Renesas facilities specifically, not across every major manufacturer associated with the region. Even so, the structural lesson remains. Geographic concentration can improve industrial efficiency while simultaneously increasing resilience risk, and the AI era does not remove that trade-off. Against those financial and physical vulnerabilities, there's also a meaningful counterpoint. Capital is still moving toward AI infrastructure, even as broader deal-making remains restrained. Asia's merger and acquisition market had a cautious first half, with China, India, and Japan leading overall deal volume. Yet within that softer environment, the AI supercycle continues to shape where money is willing to go. Digital infrastructure and compute capacity expansion are still attracting resilient capital flows across Southeast Asia, with Malaysia specifically highlighted as a beneficiary. The better way to read this is not as broad optimism returning to all technology investment, but as selective capital rotation. Investors and strategic buyers appear more cautious about general M&A, while still treating AI-enabling infrastructure, especially the physical backbone required for deployment, as strategically necessary. In other words, capital discipline and AI conviction are coexisting. The broader market may be selective, but the willingness to fund infrastructure tied to AI capacity has not disappeared. The final signal broadens the frame beyond profits, valuations, factories, and investment flows. China has launched WICO, the World Artificial Intelligence Cooperation Organization, described as a China-led intergovernmental initiative with 29 founding members and a focus on global AI governance, particularly through engagement with developing economies. That matters because competition over AI is not only about who builds the most advanced hardware or releases the most efficient models. It is also about who shapes the standards, frameworks, and institutions that other countries may adopt as they develop their own AI capabilities. The available reporting does not spell out WICO's full mandate, governance structure, membership details, or operating agenda. What it does show is intent. China is not only competing in the commercial and technical layers of AI, it is also positioning itself to compete for institutional influence over how AI is governed internationally. Taken together, these 6 developments create a more layered picture of Asia's AI boom. Samsung shows that AI-linked memory demand is already generating substantial profits. Kimi K3 shows that efficiency narratives from China can unsettle the hardware spending assumptions behind semiconductor valuations. Seoul's emergency review shows how exposed Korea's market is to global shifts in chip sentiment. The Kumamoto earthquake shows that supply chains remain vulnerable to physical concentration. Regional M&A trends show that capital still favors digital infrastructure and compute expansion, even in a cautious deal environment. And WICO shows that the contest over AI is also becoming a contest over governance. None of these developments automatically overturns the others. They're better understood as simultaneous pressures acting on the same system. The AI infrastructure build-out in Asia is not disappearing, and the evidence from memory demand suggests it remains powerful. But it is no longer a simple story of uninterrupted hardware expansion. The risk profile has widened. For investors, that points to selectivity rather than blanket conviction. Watch whether Samsung's strength in high-bandwidth memory is echoed in future quarters. Watch whether efficiency-led model releases from China keep triggering semiconductor volatility, or whether markets become less reactive. Watch whether Seoul's emergency review produces concrete policy follow-through. Watch how quickly Renesas returns to normal operations and what that says about resilience in clustered manufacturing hubs. Watch whether Southeast Asian interest in AI infrastructure, especially in Malaysia, turns into visible funded projects. And watch whether WICO develops into a substantive governance platform or remains largely symbolic. Asia's AI infrastructure story still matters enormously, but it now has to be understood through more than demand for chips alone. It runs through model efficiency, financing sentiment, physical resilience, capital allocation, and governance influence all at once.